Audio recording for this meeting has begun.
Good afternoon, everyone, and thank you for joining us for today's webinar, CRA in Rural America, Part 3, Investments in Rural America. My name is Shanteria Charleston, and I will be the moderator and host for today's call. If you've not already done so, please ensure that you have access to both the audio and video portion of the webinar. To access the PowerPoint for today's call, please follow the link on your meeting confirmation email. All participants are in listen-only mode, which means your line is muted. However, we are very interested in your questions as well as your feedback, so today during the session, to submit a question, please use the Q&A box that will appear on the right-hand side of your screen. Again, today's webinar is being recorded. Both the recording and presentation will be available on HAC's website, www.ruralhome.org, shortly following the webinar. So just a brief overview on the Housing Assistance Council before we get started today. The Housing Assistance Council is a national nonprofit organization based in Washington, D.C. that assists local organizations with building affordable homes in rural America. With a mission to improve housing conditions for the rural poor, HAC places an emphasis on striving to serve the poorest of the poor in the most rural places. HAC emphasizes local solutions, empowerment of the poor, reduced dependency, and self-help strategies. HAC assists in the development of both single and multifamily homes and promotes home ownership for working low-income rural families through a self-help sweat equity construction method. So if you're interested in learning more about HAC's services or products, HAC has an office near you. The HAC office locations as well as the contact information for each of those offices, they are currently being displayed on the screen, will also be provided as part of the webinar materials following broadcast today. Also, please mark your calendar and join us for the Serving America's Aging Veterans, a symposium taking place on May 18th in Washington, D.C. We also have a Section 502 packaging certification course taking place over June 28th through 30th in Burlington, Vermont, as well as our 2016 Rural Housing Conference taking place in Washington, D.C., November 29th through December 2nd, 2016. So again, I'd like to thank you for joining us for today's webinar, CRA in Rural America, Part 3, Investments in Rural America. I'd like to welcome and introduce our speakers for today, Keith Wiley, who will also be joined by our guest panelists and CRA funders, Vonda Eames, Robin Wolf, and Vincent Roberts. Keith is a senior research associate here at the Housing Assistance Council and works extensively with many data sets in an effort to better understand where, when, and how development patterns occur. I will also go ahead and give you a brief, really quick brief background on our panelists for today before we get started, but they will not join us until a little bit later on in the call. First up, we have Vonda Eames. Vonda is the District Community Affairs Officer at the U.S. Department of Treasury, Office of the Comptroller of Currency. Vonda Eames joined OCC's Community Affairs Department in September 2008 to assist with the Neighborhood Stabilization Initiative. Vonda serves as the District Community Affairs Officer for North and South Carolina and is the subject matter expert on CRA for Community Affairs staff. Prior to joining Community Affairs, Vonda served as a National Bank Examiner and Compliance Specialist. Our second panelist is Vincent Roberts, who we refer to as Buzz. Buzz is the President and CEO of the National Association of Affordable Housing Lenders. Prior to joining NAAHL, Buzz was the Director of the Office of Small Business, Community Development, and Housing Policy at the U.S. Treasury Department from 2011 to 2015 and was previously Senior Vice President for Policy and Program Development at the Local Initiative Support Corporation, which is the nation's largest nonprofit investor in low-income community development. Our third panelist is Robin Wolf, and Robin is the Director of Marketing and Resource Development at Community Resources and Housing Development Corporation, where she is responsible for marketing, fundraising, and grant compliance. Prior to joining CRHDC, Robin worked for over 12 years in nonprofits focused on housing and economic development, helping groups to leverage current funding as well as to get the word out about their programs and services. And so at this point, I will go ahead and turn the webinar over to Keith.
Yes, thanks everybody. Thanks for joining us. This is the third in our three-part series on the CRA in rural America. And this time we're going to look at the CRA and encouraging investment in community development in rural America. And thank you for joining us. And I want to first, before we get into the webinar, I want Shantara is going to have a poll. I'm going to turn it over to her just to judge people's familiarity on the topic before we start. So just back one brief moment to Shantara.
All right, so really quickly, everyone, you should be seeing a poll that's up on your screen, and it asks, how familiar are you with the Community Reinvestment Act? A, not at all familiar, B, somewhat familiar, C, moderately familiar, or D, extremely familiar. Wow, people have already started voting, and it looks like the vast majority of folk are either somewhat familiar or extremely familiar. We do not have as many votes for those that are not as familiar with CRA. We still have a few results coming in, so we'll give everybody another second or two before we go ahead and wrap the poll up on our tally. All right, so it looks like a dead even split between those folks that are extremely and somewhat familiar, and then we also have a dead even split on folks that are not at all familiar and moderately familiar. So we're going to go ahead and wrap up the poll. Thank you.
Yes, thanks everybody. Yeah, this is our final webinar on the CRA, and I just want to give an outline here. It's going to have the webinar is going to have two parts, and essentially the first part we've done a research paper along with the webinar that addresses outstanding lenders, and we just wanted to look at them and see what we could determine and identify about lenders that are doing an outstanding job, as their CRA rating says, because you don't often hear about that. We thought that'd be an interesting place to look if we wanted to look at the effectiveness of the CRA and how it can encourage development. And then we have a panel, as Shantara said, that's going to discuss the CRA and CRA-related investment and how its efforts to increase rural development and investments. So I think it'll be a good webinar, and mine's just going to be a brief overview of the paper, and then we're going to have the experts talk about the issue a little bit more. And before we go into it, I just also want to mention that we have, this is the third, so there were two other webinars, and I think they're good resources. With each webinar, there's also a paper. And the first webinar, CRA in Rural America, you can access it at that URL. And it provides a paper that gives an overview like of the CRA and discusses it in relation to banks, their ratings, the type of exams they take, and based on like their headquarters and their lending activity for rural areas. And then the CRA investments in rural communities, successful uses, you can see the URL there, and there's a paper, and you can go there. That's a case study paper we did where we looked at 4 cases. And Robin Wolf actually helped us on one of them, where projects were actually done. I know there's oftentimes not a lot of rural activity, but we were able to highlight some cases here we think are good examples of what is possible and the CRA can encourage, where lenders actually got credit for supporting these activities in rural communities. So you can go to these, go to our website, to these URLs, and you can download the audio of the webinar and also look at the papers. I think they're valuable resources. And this webinar is going to talk about our third paper on outstanding lenders, and we thought it would be interesting after those two to, well, just, you know, oftentimes you don't hear about the outstanding lenders and the ones that the CRA says they're actually doing a really good job. So this first slide is just going to shows over the last 2009 to 2014 period. The blue bar is the number of exams annually, and you can see it's about 1,600 exams over that period annually. And of those 1,600, about 8.2% earned an outstanding rating. So it's not common About 90% actually earn a satisfactory because there's outstanding, satisfactory, needs to improve, and substantial non-compliance. So almost 90% get satisfactory, but only about 8% get an outstanding rating. So we wanted to say, well, if we look at those lenders, maybe we can go a step further and look at those lenders that consistently earn a rating. Because what we wanted to do is, well, one time you might actually just earn it for whatever reason once, but if you consistently, year over year, earned outstanding ratings, we thought that might label you as consistently. I think the Federal Reserve, maybe in New York, has actually said that an outstanding rating means you are a leader in providing services to all parts of your community. So we wanted to look at them. And so what we did was we took all lenders as FDIC insured institution as of 2014, and we categorized them based on the number of outstanding ratings. And you can see in the figure here, the 3 outstanding ratings are ones we would consider consistently outstanding. And those, about 4% of lenders fall into that category. And I think then there's 2 outstanding, 1 outstanding. And I think the other interesting one is no outstanding. And about 79% of lenders, they only earn satisfactory ratings. So it is truly kind of an interesting and unique group of lenders that every evaluation are rated outstanding. And that's what we wanted to look at. And we wanted to look at them in regard to maybe there was some key characteristics, because they might be able to tell us more if we're thinking about increasing investment in rural areas, maybe find out the ones that are doing a really good job. So what we did was we took those lenders and we ran some basic logistic regression models. And in those models, what we found was that some of the things that you might expect, we found that the large bank exam lenders were the ones that were more often consistently rated outstanding. And that kind of stands to reason, because they are required to do community investments and development activities. And that's the type of stuff you have to do to get a rating, an outstanding rating. So those more often were the lenders that were consistently rated outstanding, and increased your odds of being so. Then we looked at their office coverage. And what we did was we said, if you had at least half or more of your branch offices located in a distressed or underserved area, as the CRA identified them, which is essentially low, moderate income, or high poverty, unemployment, or population loss areas, or remote areas, we found out that you were more likely to consistently earn an outstanding rating. And this is just the odds were greater in our logistic models. And then we did find some variation across regulators. And one thing in particular, the Office of Thrift Savings, the OTS, is no longer in existence. The OCC, the Federal Reserve, and the FDIC are the only regulators now that perform the CRA ratings. But we found that in our model, because it looked back at earlier when the OTC did exist, that there was a greater chance that you consistently earn an outstanding rating if they were your regulators. Now, this isn't to say that there was something wrong with them. It may, in fact, be the type of institutions that they were evaluating. Maybe thrifts and savings are more likely to earn their ratings. And the other element in our model that I don't have on here was we included rural geography for the headquarters of the bank. And what we wanted to see is, in our efforts, we found that there aren't a lot of lenders doing these activities, or there aren't a lot of cases where it's occurring in rural areas. So we just wanted to see if there was any relationship between the bank headquarters and earning it consistently being outstanding. And there was no relationship. And so it didn't appear that based on your location it really mattered. And so that was important to us, because that was the impetus for this research, was to see if there was a relationship there. And that essentially brings us to the panel discussion about, when we were doing this, we found out there wasn't necessarily a lot of rural investment and community development projects when we went to do a lot of this. So we thought we'd convene a panel of experts here to talk about this and about CRA and rural activity. And as Shantaria said, we have as our moderator Buzz Roberts, and he's the president and CEO of National Association of Affordable Housing Lenders. And we have Robin Wolf, who's with the Community Resources and Housing and Development Corporation of Colorado Housing Enterprises. I hope I got that all in. And Robin helped us with one of our case studies that she was involved in. And then Vonda Ines with the Office of Comptroller Occurrence. And I thought it'd be nice if they could discuss the issue further. And in general, they're going to discuss how the CRA works, their view on how it works, and their view on how it could maybe be improved. And I'm going to turn it over to Buzz now, because I think that's a really important issue, is how maybe we can improve this. And I'd like to get their thoughts on this issue and about how it can be made, to be maybe more effective or more investment.
Thanks, Buzz. Okay, so the Community Reinvestment Act was enacted in 1977 in response to allegations of redlining. And redlining was a practice by some financial institutions where they defined geographic areas where they would not lend by literally drawing red lines on a map. So the purpose of the CRA
well, thank you very much, Keith, and hello, everyone.
To help meet
appreciate your being part of this webinar today, and it's great to have two really experienced people who are actually on the front lines here. Vonda from the Office of the Comptroller of the Currency,
so to be clear,
and
the
Robin
CRA applies to banks and thrifts regulated
from Community
by the
Resources and
the
Housing
FDIC,
Development
and
Corporation.
the 12 Federal
Wanted
Reserve
to
Banks.
ask
The federal
Vonda
regulation does
to help
not
us
apply to
just
credit
set
unions,
level
although there are
for
several states that have enacted
the majority of folks who may not be deeply familiar with CRA,
for banks under their
to
shared
just give us a very
supervisory
quick
authority with the Federal
overview
Reserve
of
Banks and the
what the
FDIC.
CRA is and how it works.
OCC
I'm
supervised
going to make this
institutions
brief
are
so
not
that
subject
those
to
of
the
you who
state
are
CRA exam,
already very
although
familiar
state banking regulators
won't get
can provide
bored
comments
for
on
very
bank
long.
performance
So,
that our examiners will consider during
Vonda,
the OCC
give us
evaluation process.
the 25-cent
The CRA also sets up a framework for the regulatory agencies to evaluate a bank's performance under CRA. So to define how the agencies would conduct these evaluations, each of the agencies and basically together issued regulations and examination procedures. The regulations have been updated several times since the CRA was enacted. The last substantive revisions were to the examination process were in 2005. So the regulations define, oh, I'm sorry, Buzz. Do you want me to talk about how the regulations, or how the regulations apply to different types of banks? Great. So the regulations define 5 types of CRA examinations. Although the vast majority of the institutions fall into one of 3 categories defined by the asset size of the institution. So those are the ones I'll describe. A small bank is one that has assets of less than $304 million and are subject to a single lending test. And that might sound like a very specific number. It is, and it adjusts annually. An intermediate small bank, or what we call ISBs, are a subset of the small bank category. These banks have assets of at least $304 million, but less than $1.216 billion.
No, go ahead.
And these numbers are as of January 1 of this year. So the ISBs are subject to both the small bank lending test as well as a community development test.
I do,
Large
because,
banks
you know,
are
I
those
think
defined,
people working in
with
rural
assets of at least
communities may
1.216
find
billion,
a wide
and large
range
banks are
of
subject to
banks
a
serving their
three-prong
communities. Some
examination,
of them
and that
are very
involves a
small
lending test,
community
an
banks.
investment test,
Others
and a
may
service
be
test.
local
And
branches of
unlike
very large,
ISBs,
even
where under the
nationwide
community development
banks.
test, all of their
So
community development activities
CRA
are
doesn't
considered,
treat
these
all
activities for
banks
large banks are divided
quite
among
the
the three tests.
same.
So CD
Tell
loans
us
are
a little bit
considered under
about
the
how
large bank
CRA
lending
applies to
test.
different size banks.
Qualified investments are considered under the investment test, and community development services and retail services, such as their branches and other delivery systems and their deposit and loan products, are considered under the service test. So to give you some perspective, approximately 65 of all OCC supervised banks are considered small banks for CRA purposes. Another 21% are ISBs, and only 12% are large banks. A bank's lending performance is based primarily on the geographic area or areas a bank defines as its assessment areas. So the regulations provide very specific requirements for defining these assessment areas, but in general, these include the areas where the bank has its main office and branches and the deposit-taking ATMs. The geographic reach of bank community development activities extends to the broader statewide or regional area that includes the bank's assessment areas. So community development under CRA is defined more narrowly than community development in general, and that can be a little frustrating. So qualified activities under CRA are those that support affordable housing for lower moderate income persons, community services targeted to lower moderate income persons, activities that promote economic development by financing small businesses or small farms that meet defined size requirements, and they include activities that help to revitalize or stabilize lower moderate income geographies, areas the agencies define as distressed or underserved, non-metropolitan middle income areas, or areas defined by the federal government as designated disaster areas.
generally for the
Great.
purpose of CRA. On top of that, they do get
so here's a
affordable housing
question for
developers
either or
also
both
are
of you.
a good place that
Does
banks
CRA
look
have any
to
special
provide funding towards the
considerations
development
for
itself, and because they
CDFIs
know that
or
that's a way to
nonprofit housing
get
developers?
their products out and also to meet their CRA credits.
Yes, yes, absolutely. It would be a community development loan under the large bank test, or the loan would be under the large bank test as a community development loan, and the investment under the investment test.
I mean, there's several places where we have opportunities to interface with banks. One of which is through our statewide housing coalition. So a lot of the larger banks will have our presence as a statewide housing coalition. So we have an opportunity.
So just to loop this back to
they also our larger banks are looking to invest
description
in
of
affordable
community
development
and
also
the
have a
kinds of different
pipeline for the tax credit
activity
application.
tests that different
So
banks
they're
have.
following up with us
That construction
based on the fact that we're
loan
applying for tax
on
credits,
your affordable housing deal,
a project that
that's
we want
on the
to develop
lending
with tax credits.
test
And
for
so
a
they know
large
that
bank,
that's something they
whereas the
we'll have a conversation about, and they
tax
want to
credit
see if there's a place
investment
where
would show up
loan,
on the
from
investment
that
test. Is
institution
that
makes
right,
sense for us
Fonda?
to make the development possible. So in some ways we're sought out. In rural areas, though, it can be more difficult. So we work in rural areas across the state of Colorado. Some of them are within
Okay, great.
CRA assessment areas, and some of them
so Robin,
are for large banks.
what have you
and some
found
of
to
them
be
are
the
not
most
in CRA
effective way to
areas for
approach
large
banks
And so then
when
there's
you're
more of an
seeking
education
financing?
that needs
Do you
to take
lead
place
with
on smaller
CRA?
banks
Do
that don't
you
have
lead by
full-time
talking
CRA
about
officer,
the activity you have in mind, or
a full compliance
the strength
department.
of
And
your
so
organization,
then
or
that's
how
going in and having a conversation with, we're working in your community, you're working in this community. You know, I think our down payment products would pair very well with your first mortgage. Let's talk about how we can work together to get a product like that out. How do we work together to fund a down payment, you know, to fund the down payment program. And so it's a different kind of conversation depending upon if you're talking to the big banks who have a more robust CRA program, or if you're talking to smaller banks who might not have as much of a robust CRA program, and how much education is needed from the nonprofit developer to the bank, and how much kind of it's a relationship process, and just like a lot of things are in rural communities. And so we work and we continue to work on that for long periods of time.
So I'll start off, if that's okay, Robin. And this is strictly my opinion, but I think banks sometimes miss opportunities to highlight activities in areas that our agencies, and when I talk about the agencies, I'm talking about OCC, the FDIC, and the Federal Reserve Bank. Those areas where the agencies define as distressed non-metropolitan middle income areas and underserved non-metropolitan middle income areas. The CRA regulations provide some flexibility that's in those areas that's not afforded to communities in defined metropolitan statistical areas or lower moderate income areas in MSA as they relate to the community development activities. For example, activities that help to revitalize or stabilize a lower moderate income area in a metropolitan area must benefit lower moderate income residents in those areas. Conversely, activities in a distressed non-metropolitan middle income area must benefit the
What are some
entire
common
community,
misunderstandings
lower moderate income
that either banks or nonprofits have about how CRA works? Either or both. I'd like each of you to address it. Either one can start off.
It could be. And then when we're talking about activities that revitalize or stabilize areas within a metropolitan area, a defined MSA, we're looking at areas specifically targeted to lower moderate income geography. And those activities then would need to benefit residents in those areas. Exactly. Thanks, Buzz. Yes, the CRA defines a geography as a census tract. A list of, there is a list.
So that sounds
I'm
technical.
not aware of
so I want to draw that out. First is some rural areas are outside of metropolitan statistical areas, and some rural communities are inside metropolitan areas. So if my community is within a metro area,
and those are defined
then,
by the FDIC.
I'm within the CRA, I'm probably within the CRA assessment area for a bank that is serving the entire metropolitan area. Is that right?
You would ask the Federal Financial Institutions Examination Council. Yeah.
And by geography here, we mean a census tract or some other definition? Is there a list of low and moderate income census tracts that would qualify under CRA?
Exactly, yes.
Okay, and FFIEC stands for? Great, so that's an umbrella group that in which all the banking agencies are involved, so that there's some consistency. It doesn't really matter if you're a nonprofit, there's going to be some consistency, even though one bank may be regulated by the Federal Reserve, and another bank might be regulated by the FDIC, and a third bank might be regulated by the OCC. They all have the same defined areas, whether they're low and moderate income areas or they're non-metropolitan distressed middle income areas. Is that right?
I'm sorry, Buzz, can you still hear me?
And the reason, as I understand it, for
in some areers, those median incomes are so low,
considering activities in
there are no defined lower moderate
non-metropolitan distressed middle income areas, is that in many rural communities, low and moderate income people and middle and upper income people may live in close proximity, or they may live in very small pockets that are much smaller than a census tract would capture.
Well,
and so you have to have some kind of allowance for areas that are really isolated or economically distressed, even though the statistics might not show the same kinds of big patches of distress or low income that we would see in a big city context.
Or your programs to those, the loan officers, the bank vice presidents, to say, what are you all doing for your CRA? How is that working for you? Are you interested in making a different kind of CRA investment? We are familiar with working with with banks who do invest in us because they are able to leverage CRA. And so I think that I think it should be a point of discussion. I think you need to prepare yourself with some information. Vonda's overview is really helpful, but just getting some information on that. I have a bit of background in it because I used to work for the NCRC, which is kind of like an advocacy group
Robin,
for CRA practices.
What advice do you have to your colleague organizations
I think that anybody, after getting a little bit of education on the nonprofit level, could go out and start asking those questions. And you might get some questions back from banks that are a little bit difficult for you to answer, but there are resources at the OCC, there's resources at the Federal Reserve that we look to a lot to help explain CRA benefits with our banks. I also would tap into the Regional Federal Reserve because the Regional Federal Reserve programs do, the Denver has is part of the Kansas City Federal Reserve, and we have regional meetings with bankers to talk to them and to introduce ourselves to them. And so if you are a CDFI or a nonprofit developer, it might be good for you to reach out to your Federal Reserve local branch and see what they're doing to kind of educate banks about CRA so that you can kind of be part of that conversation as well. And that's been very helpful to us. We're about to have a program called Investment Connection at our regional CRA, Federal Reserve meeting, and that will give us a chance to present kind of investment opportunities to banks. And the Federal Reserve invites banks who are interested in making investments like that. So those are some tips, I would say, going forward, and finding ways to connect. But I do think that it can be difficult. The more remote your rural project is, the more out of the standard MSA, the more difficult it becomes because the less banks you have who are as familiar or have like a real CRA program set up. And so that's where you need to sharpen your knowledge so that you can kind of start those conversations in those communities. So I would look for the CRA person. So like at a Wells Fargo or a U.S. bank, or I would look for the regional CRA person because you're going to end up with them anyway, basically at the end of the day. And so I would look for that. If you cannot find that person, then you might, if you have, like, for example, you bank at, all of your nonprofit accounts are at Bank of the West, then you talk to your branch manager who's handling your account at Bank of the West and say, I think that there's some opportunities for you all to invest in our revolving loan fund, but it might require a conversation with the CRA officer, who is the CRA officer, for our region, and that person. I mean, we've generally found that works out really well too, but ultimately, at those large banks, there is a CRA officer, and you're going to end up talking to that person.
So if I
if
have,
you already know that person, then that's great.
if I have a branch of a really large bank in my community,
statewide housing,
do I go in to talk to somebody in the branch,
because they know that's where the people
should
are
I
they want to
start
invest
with
in. They're
one of the
often
CRA
at,
experts in that institution's
so your local
regional
Federal
or
Reserve,
national headquarters?
kind of
How do
community
I do that?
investment person will also be able to help you get in touch with those CRA touch points for those banks also. But yeah, especially at the larger banks, there will be that. At smaller banks, there's not going to be a CRA officer. And also, I think to get back, I didn't fully answer the question about what some misconceptions are that banks have about what CRA is. From my perspective, is that especially when you talk to smaller, more regional banks, you'll ask them what they're doing for CRA, and they're like, well, we provide financial literacy classes, and that's the extent of what their CRA program is about, volunteering and the direct services, but they're not fully, and that's where you kind of have to have knowledge as a nonprofit to say, well, what are you doing for your investment credit piece? What are you doing, on these other aspects of your CRA that aren't a direct service? So there's multiple ways to go about it. Larger banks, I would try to get a hold of the CRA officer who's assigned to your area. Smaller banks, I think you just have to start the conversation, go in armed with some knowledge, and see where it goes.
Okay, well, I'll start. From a regulatory perspective, the CRA has been in place for almost 40 years, and we know that in that time the banking industry and consumer behavior have changed significantly. Several years ago, I think it was back in 2010, the agencies were collectively considering and actively considering ways to reform CRA. However, to the best of my knowledge, there is nothing underway, and there are no plans to undertake changes in the CRA regulations, and some question whether addressing regulatory reform without addressing the confines in the statute would actually be worthwhile. Our comptroller did recently state in a speech a couple of weeks ago that we do need to think about, at some point, addressing this issue of how things are looked at in the assessment area and beyond the assessment area. But within the confines of CRA as it exists today, I think there are some things that might help encourage banks to support more rural development. So I think our bankers and examiners could be better educated on how activities
CRA could be improved to work better for rural communities.
Non-metropolitan middle-income areas are considered. I think examiners could periodically assess bank performance related to community development in those non-metropolitan areas using what we call full scope examination procedures. These consider the qualitative as well as the quantitative aspect of performance. And I think examiners also need to give appropriate consideration to the benefit of ongoing investments during the evaluation process, not just focus on those that originate during the current, what we call the evaluation period. That's the period of performance that the examiners are evaluating.
So in terms of CRA reform or getting CRA, more CRA in rural communities, I believe that there's an education process that has to happen. So I don't know if that's at the level of CRA assessment, if we can, get smaller banks more informed on those on those different areas. I do think that would be really helpful. And right, generally encouraging investment in the rural in the rural areas. There's a lot that gets wrapped up in Colorado in what we call like the I-25 corridor. So basically, Colorado Springs through Denver and up through the state. And so then there's a lot of areas that don't get that targeted investment because there's not the presence of some of the large institutions. So figuring out how to get CRA credits, or for banks to understand that they can still get better CRA assessments with investments in non-metro areas.
How about you, Robin?
I'm sorry, Buzz, could you repeat that for me? Well, typically, as it relates to the AHP program, the consideration for the bank is on the application side. When the bank is providing technical assistance and making application to the Federal Home Loan Bank for the AHP. If there are other FHLB programs involved that the bank can also participate in, then there could be other consideration. But typically,
well,
it's on that.
Bring in some questions from our audience. Here's a question from Jeff Mosley at the Housing Assistance Council, and he wants to know if a bank's sponsorship for awards under the Federal Home Loan Bank Affordable Housing Program can count or get consideration under CRA. Sure. If a bank is working with its Federal Home Loan Bank and it applies for and receives an award under the Affordable Housing Program, the AHP, of the Federal Home Loan Banks, how does that get taken into account under CRA? Here's a question from Kevin Hill from the National Community Reinvestment Coalition in Washington. He wants to know if OCC regulations regarding Part 24, the Public Welfare Investment Authority, do they cap how much a bank can invest in CDFIs or other community or economic